This time period that we are in right now could be one of the greatest investing opportunities of our lifetimes. I know a lot of you guys saw the pandemic drop. You saw the drop in the market coming into the first quarter of 2025. But with what is occurring now in the market, we could be in for an absolutely wild ride. Now, this is not going to be a video where I just go through and say, oh, you can dollar cost average into some of your favorite names and then look at a compound interest calculator and make it super simple for everybody. Again, I think everybody kind of knows those concepts by now. What we are going to do in this video is go through the entire landscape of what we are seeing now and what is most likely to happen next and why the current data and the current environment that we are in is going to support that type of outcome. So for those of you guys that know or may not know, my methodology when it comes to the market, when it comes to mid to long-term investing, comes down to three main things in order of importance. The first is going to be the overall macro big picture, because if you can understand what the data is telling you, what new policies are occurring, what the global landscape looks like, and what could potentially happen over the next 3, 6, 12, 18 months, well, you don't have to be as perfect in your other elements of analysis. The second is going to be individual company fundamental analysis. When company fundamentals look solid, then you can move on to the third element, and that is going to be obviously technical analysis of what the chart looks like. And this methodology is exactly how I was able to establish positions in AMD at $11.39, SoFi at $6.55, Palantir at 15, Philip Morris at 95, Robinhood in the teens. Guys, the list goes on, and we're going to be breaking down this entire landscape for you guys in this video here. So guys, if you have any questions, make sure you drop them down below in the comments. But as always, if you guys do enjoy the information and analysis I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading this information out to as many people who actually want to learn. And again, make sure you're subscribed so you never miss another video like this. And as always, big shout out to all of the members of my private trading and investing community, Less Trades, More Profits. You guys have been absolutely crushing it. It's been an awesome last couple of 2 weeks for me here as well. We've been on an absolutely awesome stretch. Remember, I'm running the best sale that I will ever offer, 50% off your first 2 months. It literally comes out to only $1 a day with code May, with that link down below. Again, guys, you get access to both the full length educational courses, the full watch list of stocks and cryptos that are about to explode before they do, the private live streams every day, the pre-market plans, the macro research reports, the weekly market research reports, the single stock research reports. The amount of value in there, guys, is absolutely nuts. And again, if you want to check that out, check out that link down below. But let's get into all of this info, guys, because we have a lot to talk about. So, as we all know, the Federal Reserve coming into this year was forecasting a significant upside move to inflation. Now, if you've been paying attention to what I've been saying in these videos here, I did not expect that to happen. Even if we were going to see any movement to the upside in this inflation data, it would be very short-lived and followed by a steep drop in demand, slowing growth, increasing unemployment, and really dragging the economy down. But that's not necessarily what we have seen. Again, February CPI data came in at 2.8%. March, we had 2.4%. And then today, we just received some new inflation data. The CPI report came out at 2.3%. So, remember, when the Fed talks about their dual mandate and their long-run inflation target, they are looking to get inflation down to about 2%. Some of you guys, especially if you're newer to the market, into really economics as a whole, might be thinking to yourself, well, inflation is inherently bad. Lots of inflation is inherently bad, but moderate levels of inflation is healthy for an economic system. So seeing inflation moving to the downside like this, you might think to yourself, well, the expectations for Fed rate cuts might start to move up in the near future, especially as we get into that June meeting, but that is not necessarily what we're seeing here. We still see only an 8.4% probability that the Federal Reserve will be cutting rates in June. July, it's a little bit higher, but still relatively low. 32.5% probability we get that first cut, and a lot of these expectations are moving out towards September. Now, why is this happening here? And it's exactly what we've been talking about on a lot of the private live streams and what what I've started to talk about with you guys on this channel here really since yesterday. And it's the fact that the market is starting to price in the possibility that this new administration, the Trump administration, is actually going to meet some of their outlined goals here with increasing tariff revenues, expanding the ability for US businesses to operate abroad, and also the potential to decrease taxes on either businesses or everyday Americans, allowing them to spend more money in the system here. And then kind of going along with this thesis, just talking about that economic data, we have not seen a sharp increase to the unemployment rate here. We are still seeing it sit right around 4.2%. And again, looking at GDP here, we did see that first negative GDP print in the first quarter of 2025 since 2022, but that was mainly the result of imports significantly rising due to everybody trying to front run the potential inflationary effects of a lot of this new trade policy and these tariffs that we have seen come out really over the last kind of month and a half, 2 months here. So just to make this a little bit simpler for everybody, the overall state of the economy right now is not in an absolutely dire situation. We have JP Morgan coming out today and dropping their US recession call after this US-China trade truce, which I will have some more details on in a minute here. And we also recently saw yesterday come out the second biggest budget surplus on record of about $258.4 billion. Now, again, people have their opinions on whether Doge is working or not. Again, some of these effects here in the surplus isn't really the result of Doge in the present, but seeing these types of budget surpluses is definitely a good thing for us moving forward here. So what I'm really saying is that the Federal Reserve may not be the one to act in order to stimulate the economy, and who is actually going to stimulate the economy here is going to have a much more drastic effect, and here's why. When we come over here and start taking a look at some more of these details, again, of this kind of pause and some of these developments here with China, Trump says China deal will open up the market for US businesses. The biggest thing that we're discussing is the opening up of China, and they've agreed to do that, but it's going to take a while to paper it. You know, it's not the easiest thing to paper. I think it would be fantastic for our businesses if we could go in and compete with China. It would be a lot of jobs for China. It would be, I think, at a time when they frankly can use the jobs, and that's what we are talking about. Remember, for those of you guys that don't know, China's overall economic situation over the last couple of years here has not been in the best spot. They've had a real estate crisis. They have had all sorts of different issues. And coming to some sort of agreement where both the US and China can benefit here will be the best for everybody. Because think about it like this. If we now have a lot of our largest American businesses that are now able to tap into a giant market in China, what is that going to do for their revenues? And with the current multiples that we are already seeing a lot of these companies at, we could see a lot of value added to a lot of these US-based companies. And China isn't the only one here that is opening up. Now, again, China, you could think of, again, a lot of these tech companies. We allow TikTok to operate here. They don't allow Facebook to operate in China. So Facebook could be a big beneficiary of this if, again, when they do paper this deal, it does allow Facebook or a company like Facebook to operate in China. That's just an example there. But again, thinking about it from maybe not a tech side, we also have some of these details from this UK deal. This trade deal will significantly expand US market access in the UK, creating a $5 billion opportunity for new exports for US farmers, ranchers, and producers. Remember, guys, exports are counted into GDP here. It does help bolster our own domestic GDP, our gross domestic product. So if we are going to continuously see a lot of these trade deals and agreements coming out, and what's included in them is allowing greater US access for their businesses to operate in these countries, it leads to more revenue, more growth, and increased valuations of these US businesses, driving equity prices higher. And that is what this market is starting to price in. Now, the other thing that we have to mention too, and just from a basic supply and demand metric, and something that we've mentioned a lot on the private live streams that I do every single day for the private trading and investing community, but we've touched on it a little bit in these videos too, is the fact that a lot of this foreign money that was concentrated in US assets, whether that be equities or bonds, has left, and at some point there is going to be a reason for that money to start coming back. Now, still, we are seeing investors pull money out of US equity funds for the fourth straight week, and this came out on May 9th. So we have not seen, again, a lot of this money that has left the United States markets even come back. And that is where we start talking a little bit about yields here. Now, when you see interest rates rise, this is the chart of the US 10-year Treasury yield. Again, this is not in the best spot here. Remember, we do have a lot of United States debt that needs to roll over this year, and having interest rates being higher, well, that's going to saddle the United States with a lot higher amount of interest payments. Now, what is possible here is that, again, when you do see that money start to flow back in and people start to realize, again, wow, this new administration actually has a higher probability than they did before of being successful, because, again, there was a lot of chaos in the first quarter of this year. Well, a lot of that money starts to flow back in, not only to US equities, but also to US bonds. So in the short term, we might see some of these interest payments going up, but I want you to think also about tax receipts. If you are able to significantly increase GDP and companies in the United States are going to be making more money, well, then they are going to have higher amounts of money that they're going to pay to the United States government, and it could increase the government's tax receipts, making this situation with the debt a little bit more manageable, even though it's not in the best situation at all. I'm not trying to say that it is, but that increased growth does help the situation. Now, thinking about this landscape here, that again, a lot of these US businesses are going to have access to these foreign markets. With these new tariff revenues, it is possible for, again, some of these tax cuts to happen later down the road and give more discretionary or disposable income to a lot of these US consumers. Well, what could be the large corporations that could benefit from some of these new regulations and the new landscape that we are heading into? Well, nvidia, again, one of everybody's favorite stocks from over the last couple of years here. Again, nvidia is sending 18,000 of its top AI chips to Saudi Arabia here. That was announced today. The announcement was made as part of a White House-led trip to the region that includes President Donald Trump and other top CEOs. Again, Alex Karp from Palantir was there as well, and we do have some announcements there. But nvidia is seeing a very significant move to the upside here today as well. Now, as we all know, we did see a little bit of a negative development recently with nvidia as it relates to selling chips in China. But if nvidia can then sell a lot of their chips to a lot of these other countries as well that the US is going to approve of, well, they can make back a lot of that revenue there and even expand into larger markets. Now, AMD, again, this was one of the first stocks that I ever bought. I own this one still at $11.39 and did not start selling until last year. So this has been an absolutely monster winner for me. My basis is negative at this point, so I'm able to ride this pretty sizable position now for free. Again, AMD looking really solid on this breakout today here as well. But why is it moving to the upside? Again, AMD and Humane strike $10 billion AI mega deal to power global intelligence. Again, very, very positive developments in the AI space here as well. And with all of this kind of overall investor craze in the AI space, I don't really think that's going to slow down anytime soon, as there's really a race across the world to continuously develop these AI products and these AI use cases, and a lot of value and attention is going to be given to a lot of these companies here. And then Palantir, another retail favorite here that is getting a lot of positive action today, breaching those all-time highs. Now, why might this may be? Well, Trump is getting ready for a $1 trillion military budget getting approved. Now, remember, as you guys all know, Palantir does see a significant portion of their revenues coming from the government. They've already shown a significant amount of government revenue growth, commercial revenue growth, but seeing Palantir potentially going and operating in some of these other countries. Again, Alex Karp was at that meeting with Saudi Arabia's officials today. That could even expand their revenues even more. Now, personally for me, I still think that Palantir is boasting and commanding a little bit too rich of a valuation in the market at this current time. I think their fundamentals are very strong, but they don't necessarily justify the valuation that they are currently at. But again, if you guys like it, you guys can absolutely keep buying this one as well. Now, the next name that could significantly benefit from some of these policies as well, guys, and we have already seen this starting to occur, another retail favorite here, and that is Hims, up another 13% today. This one does look like it's going on of a little bit of a parabolic move here, maybe a little bit of a short squeeze. Again, we were outlining this one down here at around the $30 to $31 level in the private community and up at these levels. I've been saying this before, I will say it again. To me, if I was outlining this one down at 30 to 31, I don't really want to be buying up at these low 50 levels here. Again, you got to think about probabilities and expected outcomes over time, not just the one individual outcome that you can see with one individual stock. You have to think about what is going to work for you time and time again, and what is a repeatable process. Now, again, HIMS, really strong name here, and is moving up significantly off of Trump signing this executive order that aims to slash drug prices by at least 50%. Now, if the products on HIMS's website there and the services that they are offering become a lot cheaper, well, it allows them to increase their subscriber growth and increase the amount of products that they're going to be able to sell to a lot of their subscribers, potentially increasing their average revenue per subscriber as they get introduced to more products that could actually be cheaper. Now, the last one that I want to talk about with you guys in this video here doesn't necessarily have any crazy breaking news today, but is one that we have talked about a lot on this post-earnings consolidation move to the upside here. We hit that initial target of around 1390 yesterday off of this breakout. Again, if you get through this 1450 area on SoFi here, you could easily see the upper 14s. And if this overall market move continues, you could easily see SoFi all the way back up at this $17 area in the very near future. So guys, what we really have to understand about this market right now in the landscape that we are heading into is that we are emerging from this period of chaos that we witnessed in the first quarter, and a lot of the economic data right now is starting to balance out. Again, we could easily see that upward revision to GDP, as Powell talked about a few times in the FOMC meeting. PDFP, private domestic final purchases, were actually up significantly, still showing that overall growth in the United States is here. We're seeing CPI low. We are not seeing those significant increases to unemployment, and with a lot of this new fiscal policy that we are seeing and the potential for a lot of these goals that the Trump administration has laid out for us to actually be successful, well, we could be in for one of the best investing opportunities of the recent past. So guys, that is going to be it for this video here. If you guys did enjoy the information and analysis that I provided for you guys, make sure you go down and hit that like button. Costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys are subscribed, turn on notifications so you're notified every time these videos are posted live. But until next time, guys, I will see you. Peace.